today? I am
Good,
here
thank you. How are you?
I'm doing well. So if you don't mind putting everything into chat, because with Zoom, it's difficult when we have two people speaking at the same time. I'm here to speak to you about purchasing your first home in Canada. So I've worked with many immigrants over the years, so that they can achieve their dream of home ownership. It's the Canadian dream, essentially. So I'm just trying to figure out there. Okay. So to start with, how many of you think you're ready to purchase your own home, your first home? Anybody? In the chat. Okay, so some of you are getting close. That's great. Home ownership is fantastic. It's an exciting time, and people feel that they attain security by purchasing a home and having their own house to live in, not paying their landlord's rent, their mortgage. Sorry. So where do you begin to get ready? First of all, I just want to clarify the distinction between going to a mortgage broker and going to your bank. We both can provide you with a mortgage, but there are some differences. I'm a mortgage broker, so I have access to many different lenders. I can deal with some of the big banks, I can deal with credit unions, and then there's a whole host of lenders that only go through the broker channel. So what I was saying was the differences between mortgage brokers and the bank. So the mortgage broker has multiple lenders available to them. Your bank has the bank products. So there are advantages and disadvantages to both. Your bank generally will know you. They have access to your bank accounts and they've met you before. When you go to a mortgage broker, they only deal with a mortgage. So we have to ask a lot more questions. One of the advantages of dealing with a broker as opposed to the bank is each lender has a tendency to put emphasis on different aspects of your application. Some of them will have certain programs that they offer that another lender won't. So we find the exact product that would fit your specific needs. Quite often there's the whole idea that mortgage brokers charge fees for everybody, and that is not the case. On a regular normal mortgage, we get paid by the lenders. You do not have to pay us. Okay. Remember, if you have any questions along the way, just plop them in the chat. And if I'm speaking too quickly, let me know and I will slow down. So what is the first step? It's doing the pre-approval. That is the absolute first step in the home buying process. It will tell you how much you can qualify for, like how much house you can buy. It will let you know if you can qualify for a mortgage. And what will you need to do prior to obtaining a mortgage? That's important because sometimes I pull credit and there's issues. Credit reporting services are not perfect. There's sometimes errors. It's all computerized. So we want to get those errors corrected before you're buying. Or sometimes you will need to save more down payment. Or you want to wait a little longer because you found out that you can only qualify for so much, but you want to buy a little bit more. So these are all things that you want to do at the pre-approval stage before you go shopping for a house and get excited about that house that you really, really want. It's that perfect house. So that is the reason you should go for a pre-approval. It just gives you an idea on whether you are actually ready, even if you think you are ready, right? And remember, finally, not all pre-approvals are the same. Sometimes lenders, sometimes mortgage brokers or banks will not pull your credit. I know when I do pre-approvals, I always tell people that these are the numbers, but until I pull your credit, I won't know for sure. Sometimes all you're getting is a rate hold. So you're holding a rate, especially right now, the rates are going up. We're doing a lot of rate holds. You got to ask the question, am I pre-approved or is this a rate hold? One last thing to note with pre-approvals, it's just a pre-approval. It does not mean when you find a house and you put an offer on a house, it does not mean you will get approved. It's kind of, it doesn't give you a great feeling, but a pre-approval will give you an idea. But when the lender gets your purchase and all of your documents, maybe it might not be pre-approved anymore. Maybe the house you're buying, they have to review the house you are buying. Maybe they don't like it. Maybe it's too old or whatever. They don't like the location. So all of these things, they have to approve what you're buying as well. Next thing is also if you're putting less than 20% down payment, it needs to be insured. The insurers will not pre-approve anybody. They will look at a file once you have an actual live offer. Yes, I know it doesn't make sense, but that's the reality of it. So again, whenever you put an offer on a house, always make sure you have a financing condition. So you can get out of the contract and you won't be losing any money if you're not approved to buy that house. Okay. So when you apply for a mortgage, like when you apply for any loans, we look at the 5 C's of credit. This is a guideline on what we look at. So number 1, it's your credit history. How responsible have you been with credit? Have you been making your payments on time? Are you going over your limit? So if your limit's 1,000, are you going over? That's a big thing. And how much credit do you have? Then there's number 2 is capacity. That is your ability to repay, generally your income. Number 3 is collateral. And that is your house, the security against the loan. So a mortgage is a loan that is secured by your house. Okay, so that's where they want to approve the house that you're buying. They want to know that if they have to sell the house, that they will get the money that you owe back. Capital is number 4. So that is your down payment and your net worth. So how much capital do you have? have you saved it on your own? Or are you getting your down payment gifted? It all makes a difference on your application. And then number 5 is character. And this is a tough one because it's very subjective. So it's your overall application. How does it look? Is your credit strong? Is your income strong? Sometimes some people have issues with income, but their credit is very good. And so that helps the lack of income, correct? And down payment, if your down payment is borrowed, why is it borrowed? Like what's your income like? Some people who have large incomes and no savings, they look at that, okay? So that's your overall application. We'll talk a little bit more about credit now, because that's credit and income are 2 of the most important. So building credit in Canada. So it's critical when you want a mortgage. Number 1, coming to Canada, you need to open a bank account. They want to see when you're proving down payment, you have to prove down payment, by the way. You need to show the money in an investment account, a bank account, or something. It has to be in an institution. It can't be cash that you keep in your home. There's what we call money laundering laws in Canada, and it's a federal laws, and we have to follow that. And so you have to prove wherever your income comes from. You will also need to apply for credit. I hope all of you have applied for credit when you came to Canada. So opening a bank account and apply for credit. Quite often, the big banks will have programs for new immigrants to give them a credit card, sometimes a line of credit, and open up a bank account. Take advantage of that, because it's very difficult to get credit later on if you haven't established credit. So it's always a good idea to get 2 pieces of credit. 1 credit card, maybe a line of credit, car loan. I have here GIC or RSP loan. Those are investments, but and they lend you money. Let's say you borrow $5,000 to buy a GIC, and you pay off the loan. Then you have savings. So that could be used towards a down payment. But usually the bank will require that you pay off the loan prior to using that GIC for anything else, for cashing it out. Same with the RRSP. So 2 forms of credit they like to see.
Hi, how are you?
Good. How are you? If you don't mind muting.
Yeah.
And they've asked that you turn off your video.
Yeah.
Okay. And then most important is pay all of your bills on time. It is critical because you're going to want to borrow $300,000, $400,000, $500,000 from the mortgage lender. They want to see that you will pay your mortgage payments on time. They want to know that you're responsible with credit. So pay all of your bills on time. Cell phone bills, cell phone companies are the first to report late payments. I know, it's crazy. But when they tell you to pay 5 business days ahead of time, pay 5 business days ahead of time. Okay? Very important. So pay all of your bills on time. I once had a client and he had late payments all over. And he says, what does it matter? I pay it all. But the problem was he was paying it in full, but late. And the lenders didn't like that. His credit score was really low too. So that is important as well. Make all of your payments on time, as well as don't go over limit. So if your limit is $500, don't spend $500 if you're going to be carrying, especially if you're going to be carrying a balance, which is not recommended. But if there's interest, it'll get added on and then it puts you over limit. And it doesn't matter if you pay it on time, you're over limit. So you're not paying attention to how much you're allowed to borrow. Recommended is do not use more than 50% of your limit in any given month. And of course, don't use your credit card unless you know that you can pay it off at the end of the month, so you're not incurring interest charges. So use your credit card, pay it off. I'm going to cover this one point. I see it in the chat. Carry a balance. So carrying a balance on a credit card is, it means that you're not paying off your full. So you use $200 and you're only going to pay, let's say, $100. And so the other $100 will start incurring interest. So it's not a great idea to not pay it in full. Okay, that's what carry a balance is. So I saw that there was a question on income, a couple of them. So here's the types of employment income. There's salaried, there's hourly. Hourly paid is like you get paid by the hour, but there's two types. There's guaranteed hours and not guaranteed hours. Okay, then there's bonus and overtime income and self-employed income. So salaried is the easiest to get approved. So you can use your salary, you're guaranteed your salary, there it goes. If you could get bonus and you want to be able to use bonus, because some people, some companies pay a lot in bonus and your salaries are lower. Whenever you want to use bonus, if the bonus is not guaranteed, then we need a 2-year average of income. Okay. When your hours are not guaranteed, again, a 2-year average of income. So you have to have 2 years minimum at the company that you're claiming the income for. Okay. Overtime income as well, 2-year average of overtime, because they want to see that it's consistent. Self-employed, they're the hardest to get approved, because when you're self-employed, you have a tendency to try and reduce how much you claim on your income taxes. So we always tell people, if they have a great accountant that reduces their income tax, reduces their taxable income, they'll have a harder time getting approved for the mortgage. It's reality. Okay, so if you want to buy a house, you want to check to see how much income you're going to need to claim. Otherwise, we have to go to alternative lenders, which cost more in interest and things like that. But it's possible. So these days, I'm coming across a lot of people, especially immigrants, who are working multiple jobs. And good for you, but it gets very difficult for qualifying. So quite often it's nice that if you have 2 part-time jobs, but you need to have guaranteed hours if we are not using a 2-year average. I had someone who was working 2 full-time jobs recently, and the lenders didn't like that. They did not feel it was sustainable, and we needed all the income. So it gets tough sometimes. They want to see how long you've been doing it for. So having a steady full-time job and a part-time job is ideal. Like if you want to use two incomes, but that part-time job, they're going to want to see longevity. So at least 2 years. So that's just gives you a little overview. If you want to see what you can do yourself, what your particular situation is, I'll be happy to help you, okay, by giving me a call. So the next goes to capacity. How much can you afford? So now that we've established what your income is and what we can use for income, how much can you afford with that income? And these are two key ratios that I have to use to figure out how much you can qualify for, just dollar-wise, how much house you can buy. So the first is gross debt service ratio, or GDS. So gross debt service ratio is basically your housing expense against your total monthly income. We like to see this below 39%. So your housing expense has to be 39% or less of your monthly income. Generally, we prefer to see it below 35%. Okay? You don't want to be house poor, having all your income go towards your housing expense. You want to enjoy life. You want to enjoy your house, right? But so 35% is a good rule of thumb. Remember, in Canada, we have what we call a stress test. So when I talk about principal interest payment, that's your mortgage payment, it's a stress tested payment. So what they do is they calculate what the payment would be at a much higher interest rate. Right now, it's 5.25%, where you can get a mortgage for 2.49% or 2.59. It's been going up every day. So that is the gross debt service ratio. The next is the total debt service ratio. That's your housing cost plus all of your other monthly debt payments. So that's where keeping low debt, paying off your credit cards, paying off, not getting too large of a car loan, because it'll affect how much you can qualify for. Okay, so that's against your total monthly income again. So that ratio, we like to see below 44%. Ideally, again, below 42%. Okay. So that just gives you dollar amount on how much you can qualify for. Next is your capital, your down payment. Where is it coming from? How much is required? So your minimum of 5% is 5% of the purchase price. That's the absolute minimum. Where can it come from? It can come from your savings. That's the best place, by saving. It can also be gifted from a family member, immediate family member. So it can't be a distant cousin. It needs to be immediate family member, preferably in Canada. It gets difficult when it's coming from another country. You have to remember that if you want to buy a house in Canada, because of the money laundering laws, we have to show where your down payment is coming from, and we have to give 3-month history. If you have large lump sums coming into your account for down payment, we have to prove where it comes from. And when I talk about large, some of the lenders require for as low as $2,000 being deposited into your account. Where did it come from? And you have to prove it. So my recommendation is always to try and have, if you want to buy a house, have a savings account. Put it into a TFSA, or if you're using your RRSP, but transfer regularly. Gifted down payment from an immediate family member is, it's the immediate family members, your parents, siblings. It gets very difficult when it gets into even brother-in-law, sister-in-law. So your sister or brother should be the one giving the down payment. There's RRSPs, registered retirement savings plans. If you have that, you can withdraw money under the home buyer plan for that. In some cases, they will allow borrowed down payment. Your bank will tell you no because they do not allow it. But under some programs with a couple of insurers, they will allow what we call flex down. I believe it's only one insurer now. But the rest of your application has to be very strong to qualify for the borrowed down payment. There's also different programs like the Momentum program, different programs, attainable homes that will help you with down payment. Okay, so it's always good to look under those programs as well. Then you also have closing costs. So the lenders like to see on top of your down payment 1 to 1.5% of your purchase price, in addition to your down payment. And here's some examples of closing costs. So if you need an appraisal, that appraisals are about $350, $400. Property inspection. When you buy a house, it's a good idea to get a home inspector who could check out the house, check out the structure of the house, make sure there's no major problems with the house. Check the roof. Does it need to be replaced, or when does it need to be replaced? In Canada, we have harsh winters, so, and your furnace will go, I apologize, someone's at my door. Oh, it's okay. Anyways, so the property inspection is really important because they check out your furnace, they check out your hot water tank, they check all the appliances to make sure they're all in working order. There's nothing worse than purchasing a house and then having to pay for repairs. So property inspection is pretty good. And that usually costs about $500. Then you have legal fees and disbursements. So in order to purchase a property in Canada, you need a lawyer to close the deal for you. They handle all the exchange of money, and they deal with the mortgage, and they register your name with land titles, and they register the mortgage at land titles. Excuse me, sorry, I have someone walking around here. Hello? I'm doing a presentation right now. Okay, yeah, that's me. Okay. I sincerely apologize for that. Okay, so there's also title insurance. Title insurance is something that some lenders will require, and it's about $300. And there's also title insurance that can protect you. So there's different costs, and then there's moving costs. It costs to move. So they like to see that you have money to cover all these costs. In addition to that, there's also utility companies and internet companies that might want a deposit from you if you haven't had an account with them previously. So they might require that you provide a $200 deposit, as well as when you sign up for the utilities, like your heat and your electricity. So there's other costs. So I want to talk a bit specifically about mortgage default insurance. So in Canada, we're able to buy with as little as 5% down payment. So when you put less than 20% down payment, what they have done is they will insure the mortgage. Okay, there's 3 insurance providers in Canada. The most common everyone hears is CMHC, Canada Mortgage and Housing Corporation, but there's also 2 other providers. One is Sagen, which used to be called Genworth Canada, and Canada Guarantee. So what happens is it protects the lender from losing money, basically, if you decide to stop making your payments. So if you stop making your payments, which of course none of you are going to do, the bank will basically take your house from you through a process. It takes a while, but they can take your house from you. And then what they will do is sell it immediately. That's why it's important they approve the house, because they want to know that it is marketable. Then what happens is, let's say they sell it and it doesn't cover all their costs and the mortgage balance. The insurers will pay them for the difference. I told you, though, it protects the lender. And so the insurer will then go after you for the balance if there's any shortfall. Yeah, you still pay the premium, but it's to protect the lender. And it's a one-time premium payment. So for example, if you're putting 5% down payment, you have to pay 4% of the amount that you want to borrow. Okay, and that gets added to the mortgage. And it's just that one time. But again, remember, it protects the lender, not you. So now, specifically, are you new to Canada? I guess everyone here is. Here's the criteria. You must have immigrated to Canada in the last 5 years. If you're a permanent resident or landed immigrant, you only need to put 5% down payment. You can do just the minimum. But if you're here on a work permit, you need a minimum of 10% down payment. You will need a minimum of 3 months full-time employment, unless you're transferred here with the same company and you're still with the same company. We can use that income. That's not a problem. You cannot have any delinquencies on your credit report here. It's critical, because when you're building credit, they don't want to see anything derogatory, what we say. You have to make no late payments, all of your payments on time, and you cannot have any bankruptcies or foreclosures, which is when the bank takes your house away from you. So critical that you have excellent credit, even if it's a short-term credit. If you do not meet this criteria, there are other products. There's other programs available. That's where using a broker is generally better because we have multiple products available. So there's net worth products. So you put a large down payment and you also show that you have good resources to pay the payments. There are programs like that. Resources have to be in Canada. Okay. I always recommend that if people want to buy a house and they have money elsewhere, bring it here first. And have it here for a full 3 months before you start looking. Because then you don't have to prove anything from other countries, and some of the lenders will not accept money from certain countries. Okay. Credit. We're back to credit. We started with credit, now we're back here. So under the New to Canada programs, you have opportunity. So being here less than 5 years, you have opportunity to have, you don't have to prove as much credit. Okay. If you come from a country where you have credit and there's credit reports, credit reporting agencies, it is not a bad idea sooner than later, after closing your credit in your country, to get a credit report. Because then the longer it gets stale, the longer you do not have credit, the longer your credit starts to go down, okay, just from lack of use. So it's a good idea to get it sooner than later. What they look for here is a minimum of 1 year's worth of credit history. So because you're new to Canada and you might not necessarily have a lot of credit, they'll make some concessions. So you can get a landlord letter confirming that you're making your rent payments on time. Here I have 6 to 12 months. So if you have more than 10% down payment, some lenders will allow as little as 6 months history on credit. And they will look for bank statements showing your rent payment coming out every month. Also, you can use bill payments such as your utilities. Let's say you pay the electricity at the place you're renting. We can use 6 or 12 months for utilities. Your cell phone bills, we can use that as well. Car insurance payments. So depending on the down payment, again, sometimes 6 months, sometimes 12 months. So it's great that but if you've been here 6 years, you cannot fall under that New to Canada program. So you have to make sure that you have established credit. Okay, and I noticed that there were some questions on this. First-time home buyer. You may be eligible for some incentives. Under the home buyer plan, it's a first-time home buyers. There's criteria, and you can go on the Government of Canada website and look up home buyer plan and see if you're eligible as a first-time home buyer. You're able to withdraw up to $35,000 for your RSP. And so if you're a husband and wife or 2 people buying, you each can pull out $35,000. Okay, so that's quite a down payment. There's also the first-time home buyer incentive. I'm not sure how long more that we're going to have it, but we've had it for a couple of years, maybe more than 2, but it's a top-up. So you have to put your minimum 5% down payment, and you can apply for the government to finance another 5 to 10% down payment, 5% on a resale home, or up to 10% on a new build home. And so what it is, it's a shared equity mortgage. What it means is essentially the purchasers, the government will own, like if they put 5%, they'll have 5% of your equity. So as your house goes up in value, their portion of ownership of the house also goes up, because it's 5% of the value of the house. And it gets registered on title, and you can pay it back at any time, but you have to pay it all back once. So there's pluses and minuses. Your payments get reduced, but again, the government owns part of your house. It is a program that's right for some people. Okay, like any program, there's different programs that are available, and some are right for you and some might not be as right for you. It depends. The first-time home buyers tax credit is you get $750 back of your tax paid back, essentially. It's a tax credit in the year. So if you buy in, let's say 2021, and you file your taxes, you get up to $750 tax credit. So that, don't forget when you file your taxes for the year that you buy a house to look for that. So does anyone, I see that there's been questions. Continue to put the questions in the chat box, and I guess we could start to answer some of them.
Thank you so much, Ayashah, for a great presentation. There are a lot of questions. I will get to them. This was very informative. There was a lot of interaction. There was a lot of appreciation from the participants in the chat as well. So I really appreciate a thorough presentation from you. So I will start by, I did take notes of all the questions, and if others have more, please put them in the chat and we'll try to get to as many as possible. Ayashah, if you don't mind to put maybe your email in the chat and your phone number in case, the questions we don't get to, then they can reach out to you directly. And also I'll put the clip general email address as well in the chat after